The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everybody. Thank you for joining us today at our webinar on the Tax Cuts and Jobs Act, Changes Impacting Individuals. I'm Karen Arta-Sanchez with Wilkin & Gutton Plan, and I'll be moderating today's webinar. I'd like to introduce my colleague, Lauren Landolfi, who will be presenting today's webinar. Before we get started, there are a few housekeeping items I'd like to cover. Please use the questions pane in the GoToWebinar dashboard if you have any questions. Because of the nature of the materials that we're presenting, I'm sure there's going to be a lot of questions that you all have. We will do our best to answer as many as possible. If we don't get to your question, we will be able to print the questions out and send emails responding after the webinar is done. Additionally, those of you interested in CPE or CLE credits must stay logged in the entire time, and you must respond to all polling questions that are asked. Additionally, you have to be logged in individually in order to obtain credit. We have no way of awarding credits based on group viewing, so please be sure to log in separately if you want credits. Finally, the webinar is being recorded and it will be uploaded to our website by the end of this week. I will now turn this over to Lauren.
Hi everyone. Today we are going to cover the tax impacts to individuals of the new legislation that was passed a few weeks ago. So first we will cover some changes in tax rates, then we'll talk about our changes in tax deductions, and then last we'll round it out with some changes relating to children and education. So before we get started, let's jump into a polling question just to understand what everybody's expectations are. So I'll give everyone a second to answer. How do you expect this legislation to impact you? Do you expect to have a net increase to your liability, a decrease to your liability? Are you not expecting any change, or are you not sure, and are you hoping to find out a little more today? So we'll give everyone a minute. Remember, if you're looking for CPE or CLE credit, we need you to respond to this question to show participation.
Okay, we'll give you another 10 seconds. Okay, we're going to close this now. So the results of the poll, just to give you all an idea of what you all think, roughly a third of you believe that this will increase your personal tax liability. A third of you are not sure, and the balance of you pretty much believe that you're going to see a tax savings. So that's interesting.
Yeah, very. So let's dive into our first section and talk about some tax reductions, and this is a change in our rates. So before we get into the slide and the meat of what we're going to talk about here, let's bring it back to basics. From the standpoint of our U.S. tax system, we have a graduated tax system in the U.S., meaning we don't have a flat tax. You pay the lower rates on your lower levels of income, and as your income grows, so does the rate of tax you pay on that income. And so one of the things that happened with this legislation is that we have an overall reduction in tax rates. And on your screen, you're going to see the left-hand side of your screen is going to show our 2017 tax rates, and our right-hand side is going to show our 2018 and on tax rates. Now, a few things to note here. First, these tax rates coming into play, these are in effect for tax years 2018 through 2025. Many of the individual provisions that are contained in this act are going to sunset after tax year 2025. They'll sunset back to the 2017 rates. So in 2017, we have our lowest rate at 10%, and our top rate is all the way at 39.6%. In 2018 through 2025, our lowest rate remains at 10%, but our top rate has now been reduced to 37%. The other thing that I like to point out on this slide is the impact of the marriage penalty. And for those of you that are not familiar with the concept of a marriage penalty, if you take a single taxpayer, you have one individual, and many people would think that when you're looking at a married taxpayer, you'd simply double the single rate to arrive at your married rate. And if you look at the tax tables, that's really not the case, especially in 2017. For the 10, 15, and 15% brackets, that there is no marriage penalty. But once you get beyond that 15%, you'll notice if you take the 33% line at 191,000, you'd expect that to be doubled, but instead for our married individuals, it's only 230,000. So one of the things that was eliminated for most tax brackets in the new act was this marriage penalty. It wasn't eliminated at that top 37% bracket, you'll notice, though, where you look at the single threshold. That top rate is coming into play for single taxpayers once they hit $500,000 of income. Instead of it doubling to $1 million in our married filing joint column, it's only at $600,000. So what does that mean? It means that the maximum marriage penalty is going to be $8,000 for these taxpayers. And that's the difference between where the threshold sets in at 600,000 up to the $1 million if that single threshold was doubled at that 2% rate differential. So just something to note, not necessarily anything we can plan for, but something to be aware of. The 2018 rates, so the rates that were on the previous slide, those are statutory, meaning that those thresholds where the income levels kick in, that's written in the law. 2019 through 2025, those rates will be adjusted by the IRS to allow for a cost of living adjustment. So we do expect those numbers to change and the income thresholds to move over the course of the next several years. But for 2018, those rates are statutory. Again, as I mentioned in the prior slide, assuming no further legislation, these rates that are currently in place in 2017, the old rates, they're going to come back into play in 2026. As will many other tax laws that are currently into play for our 2017 tax year. We can kind of forget them for a few years, but not really forget them permanently because they are going to be relevant again when this new law sunsets. One thing to note is taxpayers, advisors, they need to be aware of the changes to withholding rates that are tied to tax rates. So there's many sections within our Internal Revenue Code that reference back to the tax rates and that very first section setting the tax rates. So when the rate of tax changes, so does the withholding tables tied to those rates. So gambling with winnings, the mandatory withholding on certain gambling winnings, backup withholding, that rate is going from 28% down to 24%. The other thing is for executives or personnel, wage earners that are earning bonus payments or supplemental wage payments that exceed $1 million over the course of the year. The rate is being reduced to 37% from 39.6%, and that's really just as a result of the reduction in that top rate. So these are things to be aware of. As far as payroll withholding goes, we expect payroll withholding tables to be adjusted probably sometime in the first couple weeks of February. And so the impacts of these new lower rates are going to be seen in the payroll tables going forward, but it's going to take a couple weeks for all the systems to be up to date. So if you're using a payroll company, this change will kind of happen automatically, and you may not, see this other than a change in your net paycheck. But for taxpayers that have a household employee, for example, that are not using a payroll service, that are managing the payroll on their own, you will need to update those payroll withholding amounts to account for the change in withholding tables that are expected to occur. Now we have, in addition to our regular tax system, we have preferential rates for capital gains. So what is a capital gain? A capital gain is a sale of an investment property. Let's take stock, it's the easiest example. So you purchase stock and you hold it for greater than 1 year. And now because you've held it for a long-term holding period, when you dispose of that stock, if you sell it at a gain, the IRS is going to give you a tax break in the form of a favorable tax rate. In addition, the IRS gives you a tax break in the form of a favorable tax rates for qualified dividends. So these are the dividends of our, U.S.-based C corporations that we're having, the Walt Disneys, the Coca-Colas, those types of companies. If you sell these assets and you have the benefit of these preferential tax rates, instead of paying those ordinary tax rates, so the new 37% rate coming into play now, or the 2017 max rate of 39.6%, you'll get a tax break in the form of a preferential rate. And those rates are 0%, 15%, or 20%. Now, the rate of capital gains tax that you pay depends on what your regular tax bracket is. So for our lowest two tiers, our lowest two tax brackets, they pay 0% on any long-term capital gains or qualified dividends. Our taxpayers are in those top rates, so just the 37% new rate or the 39.6% old rate, they pay 20%. And everybody that falls in between pays 15%. So nothing has changed from a computation standpoint. The 0, 15, and 20% remain as it has been in the law for several years. The only thing that changes is the point at which the new rates impact this schedule. As far as the Affordable Care Act goes, there were a few impacts. We're not going to go too in depth here, but there were two things to point out. First, the Medicare surtax. This is the 3.8% tax on investment income and the 0.9% tax on earned income. There's been no change there. So that surtax is still in the law. Anything you've read that is talking about a repeal of the ACA, that's not covered under this law. What did change is the shared responsibility payments. They're going down to 0 for months beginning after December 31st of 2018. So what is that? This is the penalty tax for taxpayers that did not have minimum coverage and did not have health insurance. Certain taxpayers prior to tax year December 31st, 2018, if they did not have health insurance, then they were paying a penalty. That penalty is going to 0 after this year. So again, this is one of those provisions that is delayed. It falls a little differently than the rest of the law, and this we get a 1-year delay of implementation on. Changes to AMT. So for many of the taxpayers that are joining us today, I'm sure you're familiar with the terminology AMT. For those of you who are not, the AMT is the alternative minimum tax. And this is a parallel tax calculation to our regular tax. There are a few key differences between regular tax and AMT. First, our regular tax, again, is a graduated tax system, while AMT is a flat tax. The AMT is a flat 26 or 28%, and the rate you pay depends on what your alternative minimum taxable income is. In addition, there are items of income that are taxable for AMT purposes, but exempt for regular tax purposes. These are going to include certain incentive stock options, private activity bond interest. Those are the ones that we see most frequently. More commonly, we see deductions that are completely disallowed due to AMT. And the reason that many of you are probably familiar with this term is that many of you are probably impacted because of these deductions. So under AMT, state income taxes, real estate taxes, these are completely disallowed. So for taxpayers that are living in New Jersey, working in New Jersey, we're a very high income state. We have a high rate of property taxes. And so to completely disallow these deductions oftentimes is enough to throw taxpayers into AMT. The other thing that's really frequently happened with AMT is instead of targeting those really high income taxpayers that initially AMT was slated to impact, it's really hitting the middle income earners in the state. And so for many of our clients, we frequently saw them paying AMT, and therefore they weren't getting a benefit of their state and local income or real estate tax deductions. So what changed with AMT? The exemption has increased up to $109,400 for married joint taxpayers. It's up from $84,500, and it's $7,300 for all other taxpayers, up from $54,300. So that exemption is going to shelter a lot more income from AMT. In addition, the exemption phase-out has increased to $1 million for married filing joint taxpayers and $500,000 for all other taxpayers. Again, this provision sunsets after tax year 2025. Our takeaways as we get into the rest of the presentation and we start talking about the other facets of the law that changed, I think you'll start to see that AMT is really not going to be as big a deal. So we're really expecting to only see taxpayers in AMT that have significant options or some other, depreciation adjustments, items that traditionally weren't throwing people, the average person, into AMT. There were some changes in the standard deductions. So to start with the basics, we have a taxpayer when we're looking at filing a personal tax return. We compute what their income is, their taxable income is, and from that adjusted gross income number, we're allowed to take one of two deductions. We can take either a standard deduction or we can itemize our deductions. And obviously, when we're comparing these calculations, we're going to take the higher of the two deductions because that's going to provide us with the lowest base of income subject to tax. So our standard deductions have typically been at much lower thresholds, and the Tax Cuts and Jobs Act has really doubled those standard deductions amounts. And what you're seeing on your screen are the new standard deduction amounts. So a single taxpayer went from a $6,350 deduction, and now that's been almost doubled to $12,000. Married taxpayers are going to be eligible for a $24,000 standard deduction. So this is the provision in the law that was really intended to simplify things. Now many more taxpayers are going to be taking the standard deduction in lieu of itemizing deductions. Again, it'll be more clear as we go through the rest of the presentation and you see the other things that are changing. But these are the numbers. In addition to the standard deduction, the personal exemption has been completely repealed. So the personal exemption was based on the number of dependents that you had claimed on your tax return. So every taxpayer was entitled to a personal exemption for themselves, for their spouse, and for any children or other dependents that they claimed. The thing with the personal exemption is it was phased out. And a phase out is a provision that means as your income goes up, the benefit starts to get taken away. And once your income gets too high, then you get no benefit for this deduction at all. And so while the exemption was written in the law, many people weren't really seeing a benefit for this because their income was too high to benefit regardless. In addition, AMT impacted this as well, with AMT disallowing these personal exemptions. Now, again, the personal exemptions are completely repealed. There is an additional deduction for elderly and blind individuals, and that remains. So that kind of fell into that standard deduction category, not the exemption category. So for those taxpayers that were claiming an additional deduction based on their age or the fact that they were blind, that has remained in the law with no changes. So now let's jump into another polling question. Again, these are for CPE, CLE purposes. If you could just take a minute. Which of the following is not a tax to which an individual is subject when calculating their personal income tax? Taxpayers, do they pay an alternative minimum tax, a capital gains tax, an excise tax, or the additional Medicare tax? We'll just give everybody a few minutes or a few more seconds to get their answers in.
Okay, about 10 more seconds and then we're going to close this poll. Okay, poll's closed. Thank you very much.
Thank you. And for those that are curious for the answer, individuals do not pay an excise tax. So now let's get into our next section and the changes to itemized deductions. So as we mentioned before, again, the itemized deductions, these are going to be for the taxpayers that choose to forego the standard deduction because their itemized deduction is going to result in a higher tax benefit for them. So we are going to go through each of these specific tax deductions in detail. There were changes across the board that are going to impact individual taxpayers. So first, let's talk about mortgage interest. Taxpayers in 2017 are allowed to deduct mortgage interest on mortgage principal of up to $1 million. So If you own a home and that home has a mortgage balance of $2 million, you will be able to deduct 50% of that mortgage interest, or only the mortgage interest that relates to that first million of principal. In addition, you're entitled to a home equity interest deduction for home equity indebtedness of up to $100,000. So in total, we had a mortgage interest base of $1.1 million. Now, this mortgage interest was available for both your primary home and one additional home. And so as long as your total principal didn't exceed those threshold amounts, you were able to deduct all of the interest on those mortgages. In the new law for 2018 through 2025, interest is only allowed on acquisition indebtedness up to $750,000. Now, there's a few things to point out with that statement. First, the term acquisition indebtedness is important. We've had many people that we've spoken to, many of our clients, really questioning, well, what if I have a home equity line? Many times taxpayers kind of get to the end of their mortgage, and their home equity line, the rate provides a better benefit from them. It's just a more cost-effective option. So they'll pay off the mortgage and just take out a home equity line for the balance. That really still represents acquisition indebtedness. If we look at the purpose of those funds, it was used to acquire or maintain or improve their primary residence. And because of that, we will still be able to classify that as mortgage interest eligible for a deduction. The other thing that's important to note here is this $750,000 threshold is only relevant for new mortgages. So if you purchased a home 5 years ago with a $1 million mortgage balance, and that principal balance has not fallen below $750,000 at this point, you're still okay. You're grandfathered into the existing laws. So the new $750,000 threshold comes into play for mortgages after December 15th of 2017. Now, there may be some taxpayers or some people viewing today that fell into this very small group of people that went to purchase a home and were kind of in the market late last year and were under contract and were supposed to close by year end but didn't, for whatever reason, we're not able to. There is a special grandfather rule for those individuals to leave that limitation at $1 million. It is very specific as far as qualifying for it. So if you think you are impacted by that, if you are somebody that has recently closed on a home or plan to close on a home in the next couple months before April 1st, please talk to us. Let us know if we can help you clarify if this $1 million threshold will apply to you. Now, after December 31st of 2025, the cap is going to go back up to $1 million regardless of when the debt was incurred. So if you go out and purchase a home today with $1 million mortgage, you're going to be limited to that $750,000 threshold. But in 2025, if your mortgage principal balance has not gone down below $750,000, you'll be able to deduct up to $1 million worth of interest, or the interest relating to the $1 million of principal. So the next big thing that's going to change relates to state and local income taxes. So currently in 2017, we are allowed to deduct our state and local income taxes that we pay. And so for many of you, you are probably a W-2 employee where you have a paycheck that you have your income and your withholding taxes are coming right out of your net pay. And for those taxpayers, you would give your W-2 to your tax preparer, and they are able to pick up the income tax deduction on your tax return as an itemized deduction. That's not changing for 2017. In 2018 to 2025, there's going to be a cap on the dollar value, and that cap is going to be $10,000. The important thing to note here is it's also going to be in conjunction with the property tax deduction. So the combination of your state and local income taxes, sales taxes, and property taxes are not going to be able to exceed $10,000. That limitation is $5,000 if you're married and you're filing a separate return. There's a few things to note here. First, if we go back to the beginning in the first polling question, many of you believe that your tax liability is going to go up as a result of this legislation. And I'm sure for many of you, the reason you think that your tax liability is going to go up, it could be tied to this provision. Karen and I have done a lot of presentations over the past month, and we've met with a lot of people, and the conjunction and the feelings among people are that this is a huge deal, and this is really going to be very impactful for the people in New Jersey. But I'd like to caution you and really make sure you understand what kind of benefit were you getting prior to 2018. Were you an AMT? If you were an AMT, then the chances of that tax deduction really offering you any tax savings, it may not have been the case. Oftentimes taxpayers, they give their tax documents to their preparer, and they see a number go to a form, and they, I claim that tax deduction. They fully believe that there was a benefit there. But if you were an AMT and if you don't understand how to really read your taxpayer, it may not be quite as bad as you think. In addition, when we talk about our overall tax rates being reduced, we're hoping the combination of the two will result in at least a net neutral, but hopefully tax saving position for taxpayers.
There's a couple of questions related to the mortgage interest deduction that I think we should address at this point. So the first question is, does the mortgage, actually two questions are the same. Does the mortgage interest deduction still apply for first and second home?
I believe it does. Yeah, I don't think they changed that in the law.
Okay. And home equity interest, going forward, that will not be deductible anymore.
Again, it depends on what you've used the proceeds of that home equity line for. If you used it to pay for college, to buy a car, then absolutely not. It's going to be non-deductible. If you used it to put an addition on your home, to repay off your mortgage, then we're going to fall into this acquisition indebtedness factor and definition, and then you'll be okay.
Right. So the point with that, what Lauren is saying, is that you have to trace your proceeds back to their use. So when Lauren presented on the slide a couple of minutes ago, what she said is, if you use a home equity line to pay off your primary mortgage because the rate is lower, that refinance of that mortgage or the replacement of one type of debt with another type of debt will still qualify as mortgage interest or acquisition indebtedness, and that interest will still be deductible. So going forward, that rule still applies. We still have that interest tracing rule in place. So as long as it relates to the acquisition or improvement of your home, whether it's an equity line or not, the interest will still be deductible.
Okay. So let's move on into our next change in tax deduction, and this is going to be real estate taxes. So I kind of highlighted on the last slide what we were going to be talking about here, but first let's talk about 2017 law. And 2017 law says that real estate taxes are deductible as an itemized deduction. There's no limitation on the number of homes. So if you're fortunate enough to own a home in all 50 states, then you can deduct the real estate taxes on each one of those homes. Now, in 2018 to 2025, those real estate tax deduction amounts are going to be capped at $10,000, and that's again in conjunction with those income taxes as well. So as you can see, this is very impactful. How many taxpayers in New Jersey have real estate taxes alone that are in excess of $10,000 or very close to that amount? This could be big. Now, there are a few things to note here on the prepayment of real estate taxes. So many of our clients were in touch with us and heard from us prior to December 31st of this year. And they heard from us with respect to one really unique planning opportunity that we had for real estate taxes. So the mid-December, we started talking about prepaying our real estate taxes. We actually were talking about prepaying income taxes as well. And making those payments before December 31st in order to reap this one-time benefit the last year of our tax deduction before this new law comes into play. Well, Congress got hip to what practitioners and taxpayers were doing, and they expressly prohibited the prepayment of income taxes in the law. And so the first thing that we could do, prepaying income taxes, that was out of the running, not possible. But when they made that distinction, they did not mention real estate taxes. And so this one-time benefit was available to us. Now, in the meantime, the IRS has offered some clarity, and they have issued regulations that say the tax must have been assessed before 2018. So for many of you on this call today, you are New Jersey taxpayers with New Jersey real estate taxes. And those New Jersey real estate taxes are generally assessed for the first 2 quarters of 2018. So when you were sitting in your office on December 31st, you had a tax bill in your hand that had your first 2 quarters of real estate taxes already assessed. As long as you paid those first 2 quarters by December 31st of 2018, by December 31st of 2017, you will be entitled to a tax deduction on your 17 return and really be able to reap the benefits of this one-time tax savings opportunity. Now, for those of you that may not have heard from us, it's probably because you were in AMT and are frequently very deep in AMT, and a taxpayer that is in AMT wouldn't benefit from this strategy. The other thing with respect to real estate taxes is our foreign property taxes. So we have in 2017 taxes on a foreign residence deductible as an itemized deduction. That is not changing for 2017. If you own a home overseas, if you own a home in Mexico, you are able to deduct your foreign property taxes. In 2018 to 2025, the deduction for foreign real estate taxes is suspended. So those foreign real estate taxes are non-deductible, assuming that they relate to personal real estate. Next, we'll talk about some deductions in charitable contributions. So in 2017, we have cash contributions subject to an AGI limitation of 50%. What does that mean? If you're a taxpayer earning $100,000, you are able to deduct up to 50% of your charitable contributions and reduce your taxable income. Any unused carry forward, any unused charitable contribution is carried forward for 5 years. So you're able to use it in the current year up to 50% of AGI and then carry it forward for a 5-year period. Now in 2018 to 2025, there is a change to the cash contribution, and that is that the AGI limitation is going up to 60%. So now instead of having a cap at 50%, it's going up to 60%, which means much more of your income can go to a charitable contribution. Now, this may not be very impactful for taxpayers, at first glance, because for a taxpayer to be giving 50% of their income away to charity, they're clearly very charitably inclined already. And when you bring it up to 60%, they're even more charitably inclined. So who would this really benefit, this expansion? Think of a taxpayer that has kind of an unusual 1-year, spike in income that, has a charitable mindset. They may be able to front load some future year contributions by making donor advised fund contributions or some other planning techniques with respect to charity. So while we do expect this to have a limited impact, there are some taxpayers that may benefit from this. The other thing to note here is that there's actually a planning point with respect to charitable contributions that taxpayers can use, going forward for charity. If we talk about our itemized deductions, we know a married taxpayer, they need to exceed $24,000 in order to itemize. That $24,000 number, again, is our standard deduction. So they're not going to itemize until they exceed that. If we talk about what deductions they have, the 2 most frequent items we're going to see are going to be our real estate taxes and income taxes and our mortgage interest. So if we know our mortgage interest, or if we know our real estate taxes and income taxes are capped at $10,000, that means our mortgage interest needs to be in excess of $14,000. For taxpayers that are kind of right at that threshold with their mortgage interest or itemizing in general, We may want to use a bunching strategy with respect to charitable giving. And what does that mean? That means we want to kind of straddle our charitable giving so that it all happens in one tax year. So maybe you make a very large donation at the end of 2018, but you also prepay your 2019 charity by the end of 2018 so that all of your itemized deductions, your charitable contributions are hitting one tax year, and that's going to throw you quicker to that $24,000 threshold and get the benefit of itemizing. Changes with respect to medical expenses. This is an area where we saw a favorable change in the law. So the medical expense, this is the first place we're going to see a floor provision, or the first time we'll talk about a floor provision today. And the medical expenses are deductible to the extent they exceed 10% of your AGI. So what does that mean? Let's again take a taxpayer that has $100,000 of income. We multiply their income by 10%. To get $10,000, and only those medical expenses that are in excess of $10,000 are going to provide for tax savings. In 2016, that 10% is reduced to 77.5% for taxpayers that are age 65 or older. Now, what the Tax Cuts and Jobs Act has done is they have made that 7.5% threshold available to all taxpayers regardless of age. It's important to note the years here. This is one of the provisions that doesn't conform to the standard dates. This is a provision that is effective for taxable years beginning after December 31st of 2016 through December 31st of 2018. So this is available now for our 2017 tax filings, which we're gearing up to get into that filing season now, as well as our 2018 tax year. After 2018 and tax year 2019, we are going to go back to that pre-2017 law with a 10% and 7.5% floor depending on your age. So current benefit here. Changes in our miscellaneous itemized deductions. So in 2017, there is this catch-all for unreimbursed miscellaneous itemized deductions. So this is going to be unreimbursed employee business expenses, investment expenses, tax prep fees. This is another area that we see a floor. That floor is 2% though instead of 10%. So as you can imagine, more people would be entitled to that miscellaneous itemized deduction at a 2% floor instead of that medical deduction at a 10% floor. For tax years 2018 through 2025, this is completely suspended. So there are no longer going to be deductions allowed for miscellaneous itemized deductions until this law sunsets. Now, again, I'd like to caution people before they get too excited or too concerned about this provision. Again, this was one of the provisions that deductions that was added back under AMT, so it was completely disallowed. So for many taxpayers, for many of our clients, they were claiming this as a deduction on their return, but they weren't receiving any tax benefits or weren't seeing any tax savings because of the AMT impact. Casualty losses. So a casualty is a personal loss that exceeds $100, and it's a result of a firestorm, other casualties, shipwreck, and it's deductible as a personal casualty loss. Another area, again, where there's a floor, it's a 10% floor. It's important with a casualty loss to realize that this is after insurance proceeds. So for many taxpayers, if you did incur a casualty, oftentimes it's covered by insurance, and therefore you wouldn't really have a casualty loss because net you wind up equal at the end of the day, or your total loss doesn't exceed the 10% floor, and it's more of a minor loss. In 2018 to 2025, personal casualty losses are repealed unless they're attributable to a federally declared disaster area. So for taxpayers that have, a one-off fire or one-off flood in their home that traditionally would qualify for a casualty loss deduction if it was not insured, in 2018 to 2025, they unfortunately will be impacted and will not be able to deduct that casualty loss. If we talk about, our federally declared disaster areas, if we think of, our big storms, so our hurricanes, our floodings, our massive floodings where it turns into a disaster area, those will still follow the old law. The same floors and limitations will still apply, but, we'll still be able to see the benefits there. The other thing that was happening in tax years 2017 and prior is there was an overall limitation on itemized deductions. And so these were referred to as our PEAS limitations. And it really meant that for high-income taxpayers, we would total all of their itemized deductions, but because they were classified as high-income taxpayers, there was a haircut and all of the deductions were not allowed to offset their taxable income. In 2018 to 2025, the PEAS limitation has been repealed. So we expect this to be a favorable measure for our high-income taxpayers because now they're going to get a dollar-for-dollar reduction of their taxable income with their charitable contributions, with all $10,000 of their income tax deductions, as opposed to 2017 where the limitation is still in play. So again, this is more of a favorable provision that was written into the law, and it also makes things a bit less complicated not having to calculate that PEAS limitation. The alimony deduction is another area that we see some changes. One thing to note here is that the conforming dates, they don't match the rest of the individual provisions. There is going to be a delay in our new law. So let's talk about tax years 2017 and 2018. What happens when there is an alimony? So if you have a divorce agreement that has an alimony component in it, the way the divorce agreements are written, the payer of the alimony is entitled to a tax deduction in arriving at their adjusted gross income, and the recipient of the alimony has to pick up that alimony as income in arriving at their adjusted gross income. So it's really a shift of income from one spouse to the other. And this is something that's written into alimony agreements based on the tax impact. Obviously, the attorneys understand the tax impacts of alimony, and they know that there's going to be a tax liability shift as a result of this alimony payment. And when they're calculating that dollar value to tie to alimony, the tax impact is factored into it. In 2019 on, they're going to change the treatment of these alimony agreements. And what's going to change is that the person that's paying the income, paying the alimony, they're no longer going to be able to take a deduction for that. And the person that's receiving the alimony will not be picking that up into income. Now, it's important to note that this is effective for agreements executed after December 31st of 2018. So for taxpayers that are currently, in a divorce agreement that has alimony, you will not have to conform to these new rules unless you want to. If you do want to modify your alimony agreement and your divorce agreement, and you do want to conform to the new rules, it's important that you expressly mention this provision within the modification that you're going to conform to the Tax Cuts and Jobs Act.
Okay, I know that might be a problem with the slide that it did not advance, so just bear with us, and we are working on fixing that.
Okay, so continue on while the back end is working on our slides. We have some moving related provisions that are changing. So we have an exclusion. Exclusions for qualified moving expense reimbursements is suspended for tax years 2018 through 2025. So these are for taxpayers that are receiving moving benefits from their employer for a move. They did not have to pick that up into income. In addition, the moving expense deduction is completely suspended for tax years 2018 through 2025. Moving expenses under current law, under 2017 law, they really were available for taxpayers that were making job-related, long-distance type moves. So there's a mileage limitation. It really needs to be a very specific job-related move in order to be relevant. Now, the above two provisions, they are not going to apply to active duty military moves pursuant to military orders or a permanent change of station. So again, we're really talking about our non-military related moves, and these provisions are going to be relevant for tax years 2018 through 2025. We have another polling question we're going into now. Let's just give us a moment to get the slides back up for you. We're going to launch the poll. So for those of you that are joining us for CPE or CLE credit today, if you could please respond to the polling question. We'll give everybody another minute to get that polling question open.
Presentation, I'm gonna stop sharing.
Okay, one more second, guys. We're going to give you for this polling question, and we're getting our slides back up. All right, can we close this question?
Okay.
And let's move to our next slide. So next we're going to round off with our discussion of children and education. And I know you are still seeing the polling questions. They are working on it on the IT end.
Okay. Obviously, we're having a bit of technical difficulty, so we appreciate your patience while we work through this. So just sit tight for a second.
Okay, so we think we have our slides back up. We'll let you know as soon as we can, but in the meantime, let's keep moving. So on the topic of children and education, the first thing we're seeing is an enhancement of our child tax credit. And what is the child tax credit? The child tax credit is something that is available to taxpayers with children, and it's a per child credit. And it's based on the number of qualifying children that you had. And in tax year 2017, the qualifying child's credit amount was $1,000 for a qualifying child and $0 for any other dependents. Now, the really important thing to note here is the thresholds at which the 2017 credit phased out. And for single taxpayers, that phase out was $75,000. And for married taxpayers that were filing joint returns, that credit phased out at $110,000. So obviously, this was not a very impactful credit for individuals because at $110,000 of income, especially in New Jersey, it was very easy to be phased out. Now, the Tax Cuts and Jobs Act has enhanced this credit in two ways. First, the credit is up to $2,000 for a qualifying child and $500 for any other dependent. In addition, up to $1,400 of this credit is now going to be refundable. Now, the other thing, in addition to really doubling this credit and making it more from a dollar value standpoint, those phase outs really blew up. And so a single taxpayer is entitled to a $200,000 credit, where a married taxpayer is entitled, the phase-out range starts at $200,000, excuse me. A married taxpayer, that credit comes into play and doesn't start phasing out until the taxpayer reaches $400,000 of income. So again, much more impactful. When we talk about a married couple with $400,000 of income, they're much more likely to see a benefit for this. So let's talk about quickly, what is a qualifying child that would be eligible for that $1,000 credit? And first, we're going to talk about the relationship. There's a relationship test. Is it a linear descendant? So your parents, your children, your grandchildren. Is it a brother or sister, a child of your brother or sister? They would qualify under the relationship test. In addition, how old are they? What is their age? If they are younger than you and younger than age 17, if they're younger than age 24 and also a full-time student, unless they're permanently and totally disabled. So as long as the child meets one of the age criteria tests, we're still good under the qualifying child. Next, we have a residency test. And the residency test says the child has to live with you for more than half of the tax year. So the child has to be physically present with you. There's special rules if the child is at college, obviously that falls under a different category. The child cannot file a joint return and they must have a social security number. So if we pass these tests, then now we're considered a qualifying child, and a qualifying child is eligible for that $2,000 per child credit. Now, in addition, this is the first time we're seeing a credit for a qualifying relative. So who is a qualifying relative before we get into the definitions? You may think of a parent that you take care of, somebody that is not your child, but that you are still providing support for. And so from a standpoint of the list of things that qualify somebody under this, they're not a qualifying child of you or any other taxpayer, so they didn't meet the tests on the prior slide. They are a member of your household, or they pass the relationship test. So for somebody to be considered a qualifying relative, they have to live with you for the full tax year unless it's your child, your parent, your sibling, or your sibling's children. In addition, a qualifying relative has a gross income test. And that gross income test means that they cannot have more than $4,050 of income, and they cannot be supporting themselves. Somebody else has to be providing, the taxpayer has to be providing more than 1/2 of that person's total support. You'll notice with the qualifying relative test, they do not have an age test that they need to make, so it could really be somebody of any age. And if somebody qualifies under these sets of rules, then they'd be entitled to that $500 credit. Now, the enhanced child tax credit, there is that phase out, and how is the phase out calculated? The phase out is reduced $50 for every $1,000 of income over the threshold. So it seems a little more complicated, so I think it's better to go through an example here. If we have a married filer that has $500,000 of modified adjusted gross income and 4 qualifying children, what would their credit be? First, we would look at how much their income exceeds the threshold. So again, that threshold is $400,000 for married individual. Their income is $500,000, so we're $100,000 in excess of that amount. And so when we divide that by $1,000 and multiply it by that $50 reduction, we're getting to a total $5,000 reduction. So if we take our 4 qualifying children that were each entitled to a $2,000 credit, our credit before a limitation was $8,000. We have just calculated a $5,000 reduction, and so this taxpayer with $500,000 of modified adjusted gross income would still be entitled to a $3,000 credit. Now let's take that same taxpayer, and they have $500,000 of income, but they only have 2 qualifying children. Now, for this taxpayer, the phase out is, it's completely phased out because now their original credit is only $4,000. So it's the 2 children times $2,000, and we have a complete phase out now because our reduction is $5,000. We have a 529 expansion, so continuing on the theme of kids. Now, a 529 plan, this is a savings plan for college, and it really historically was a college-related provision. So you put money into this plan, it allowed to grow tax-free, and if the money came out for qualifying expenses, none of the earnings on that funds were going to be taxable. So that definition remains, but it's actually been expanded to allow for disbursements for elementary or secondary schools. So if you have a child that's attending Catholic school, traditionally you were not able to take a 529 distribution and have it qualify. That definition has been expanded, so now those elementary and secondary schools are going to be included. If you do take a distribution for elementary or secondary school, it's important to note that the expenses are capped at $10,000 per beneficiary per year. So it's not quite as favorable as the college, tuition benefits, but it's still much more favorable than the prior, which was no benefit at all. And this applies for distributions after December 31st of 2017. Okay, we're going to talk about the Kiddie Tax next. The Kiddie Tax applies to the net unearned income of any child who is under age 19 by the close of the tax year or a full-time student and under age 24. They had at least 1 living parent at the close of the tax year. They have unearned income of more than $2,100, and they don't file a joint return. So if we think conceptually what the Kiddie Tax is telling us to do, it really is saying taxpayers that are high income, they can't shift money into their kids' names and have the kids benefit from the lower rates. Those kids are going to be taxed at the much higher tax rates. Now with the Kiddie Tax, law changes are under the Tax Cuts and Jobs Act, or they modify the calculation of the Kiddie Tax in a couple ways. First, the Kiddie Tax previously was calculated based on the parents' rates. And so we really needed to wait until the parents' returns were completed, until the siblings' returns were completed, and we needed to tie the parents' rates to that income. The Tax Cuts and Jobs Act has modified this, so now the Kiddie Tax is going to be computed at the estate and trust tax brackets. And for those of you that are familiar with the estate and trust tax calculations, the thresholds and where that 37%, that top rate hits, it happens much quicker for an estate and trust. For a single individual, that 37% bracket isn't hitting until $500,000, whereas for a trust, that 37 bracket hits at $12,500 of income. So there's a much bigger spread there, and it's very, very easy for an estate or trust to get to that 37% bracket because the threshold is basically non-existent. So this is really going to make the calculation less complicated, but it's going to make the tax on unearned income of children higher because now they're not going to have the benefit of those lower rates. as far as earned income of children, now that's going to be calculated based on an unmarried individual's tax brackets. So this really is the end result. We're going to get to a similar situation. It's going to ease the calculation just a bit as far as not having to wait for a parent's return to be completed. We are at our last polling question, and we're nearly done our presentation for the day. The child tax credit has been expanded, and more tax filers will qualify for the credit under the new law. We'll give everybody just another 10 seconds to wrap this poll up. Okay, we're going to close it down. And again, that child tax credit was expanded as we demonstrated. So the last thing I wanted to highlight today were some changes to the estate and gift tax laws. While it's a little more out of scope of this presentation, the rest of our web series is not going to cover estate and trusts in particular. So I wanted to highlight this. So first, the estate and gift tax exemption, it doubled to increase the exclusion amount to $10 million. Now, this is a statutory $10 million. It's indexed for inflation after 2011. So for some of you that are sitting there that are familiar with this number and are saying, no, the number is not 10 million, it's more than that. This is the statutory law amount, and it's indexed for inflation. So in 2018, what does that mean? The exemption is $11 million or $22 million for a married couple. So it's really doubled the threshold and made it much more, there's much more opportunities for gifting, and this is going to be effective for decedents that are dying and for gifts that are made after December 31st of 2017. So this is what our attorney friends, I'm sure, are working on now, is really taking advantage of this extra $10 million of exemption that's available. And just one thing to note is the gift tax annual exclusion for 2018 is up to $15,000. And with that, that concludes our presentation for today. You can join Karen and Len tomorrow. They'll be highlighting some business and relevant provisions there. Join Vinay on Thursday for our foreign tax updates. And then later this month, we also have an update on the real estate impacts as well. So we hope you enjoyed our presentation today. Thank you for bearing with our technical issues, and enjoy the rest of your day.